Welcome to the Nifty Yoon podcast.
We've got a really interesting one for you today.
We've carved out a dedicated deep dive, slicing through 5 consecutive days of our Nifty Noon newsletters. It was a particularly dense week, running from December 8th right through the 12th, 2025.
You know, that 5-day stretch was less a wave of news and more of a systemic shift. It's so easy to get lost in the daily noise.
For sure.
So our mission today is really to extract the absolute most important insights from those updates. We want to give you the shortcut to understanding the fundamental movements shaping, well, at least the next quarter.
Absolutely. When we aggregated the insights from that week, 4 central narratives just jumped right out. They really show how quickly this space is merging with legacy finance and culture.
First up, we had what we're calling the culture shock event. That was Beeple's polarizing, but, commercially stratospheric new installation at Art Basel.
Then second, we move straight into traditional finance with this aggressive institutional yield hunt. That was signaled by BlackRock's really unexpected and significant filing for a staked Ethereum ETF.
A huge signal.
It just takes institutional validation to a whole new level.
Then third, the focus shifted to fixing the plumbing. You had major players tackling fundamental payment infrastructure problems. This was the launch of Tempo, a dedicated low-fee stablecoin blockchain from Stripe and Paradigm.
Designed to completely eliminate gas fee volatility.
Exactly. And then finally, the week culminated in this massive regulatory watershed moment. We watched this messy, high-stakes political battle over the U.S. market structure bill.
And it collided head-on with this monumental, almost quiet news. The DTCC, the backbone of Wall Street, getting the green light to tokenize trillions in real-world assets.
Those 4 points just illustrate the sheer speed of this convergence. We are going to tackle these updates chronologically, starting with that intersection of art, tech, and, well, spectacle.
Okay, let's unpack this. We're starting on December 8th in Miami. Beeple's Regular Animals installation at Art Basel. This was the ultimate statement on tech, algorithms, and really capitalism.
It was art, but it was also a massive commodity event. It was designed to provoke, and it definitely succeeded. A commentary on the power dynamics shaping our digital reality, but wrapped in a package that was, undeniably marketable.
For anyone who missed the description in our newsletter that morning, just picture this. You've got robotic dogs, the kind you see doing synchronized backflips on YouTube.
Right.
But these dogs were wearing these hyper-realistic masks of tech moguls, specifically Elon Musk and Mark Zuckerberg.
And they weren't just static sculptures. They were actually roaming the floor. As they moved, they'd capture photos of the crowd, and then an internal AI would interpret those images through the lens of that mogul's supposed persona.
That algorithmic bias.
Right. And the final product was then physically, well, for lack of a better word, excreted onto the gallery floor as a tangible print.
A very, very expensive physical print. The mechanical setup was wild, but the hook was the digital layer. A portion of those prints had QR codes. So the lucky person who picked it up could claim a verified NFT on the blockchain. The physical art was basically a receipt for the digital collectible.
And the project's stated mission was to examine how we increasingly view reality through this, distorting lens of powerful algorithms wielded by tech giants. It's asking who's setting the filter for our perception.
A good question.
But what really stands out to me is the immediate, almost predatory commercial success of that exact critique.
You're absolutely right. Despite how strange and polarizing it was an undeniable commercial smash. The newsletter reported that all of the robotic units, each priced at a hefty $100,000.
$100,000, wow.
They sold out during the VIP preview. The public didn't even get a chance.
And that's where the market insight really crystallizes for you. The secondary market response was instantaneous. We noted that one of those freely claimed NFTs, a digital souvenir you literally just picked up off the ground, sold for 10 ETH.
Which was about $30,300 at the time.
Just hours after the show opened. It's just incredible.
That's a powerful arbitrage between a free piece of paper and a 5-figure digital asset. It shows that in this space, cultural relevance instantly translates into economic value, even if the statement itself is a critique of the system creating that value.
It's a true meta-commentary, and this wasn't happening in isolation. This whole cultural fervor was underpinned by some really robust market metrics. While Beeple was driving headlines, the institutional action was, I'd argue, even more profound.
For sure. We noted that week that Bitcoin was holding strong above $91,000 and Ethereum was over $3,100.
And more importantly, the newsletter highlighted that relentless institutional accumulation. Funds like Tom Lee's BitMine were purchasing this massive chunk of ETH that week.
Their cumulative buying power means they now collectively own over 3.16% of the entire circulating Ethereum supply.
They're watching the cultural shifts, sure, but they are systematically vacuuming up the underlying assets.
Which is the perfect segue to December 9th, where the yield hunt just went into overdrive. This is BlackRock, already managing billions in crypto, coming back to the SEC with a major new filing.
Right. They filed an S-1 registration statement for the iShares Ethereum Staking Trust, ticker EPHB.
So for our listeners who aren't steeped in financial jargon, what does filing an S-1 actually mean here? And why is this ETHB filing so different from their existing funds?
Okay, so the S-1 is basically the initial registration form required by the SEC. Think of it as the formal application to launch the investment product. Now, BlackRock already has its huge $11 billion spot youth fund, that's ETHA.
Right.
The key difference with ETHB is one word: staking.
So ETHB isn't just designed to track the price of Ethereum. It's designed to actually capture the staking rewards from the network and pass those through to the investor.
Precisely. The goal is to give investors guaranteed yield, making Ethereum a productive asset in a regulated trust without the client needing to manage all the technical complexity, the lockup periods, or the self-custody risk.
It's institutionalizing yield.
That's the perfect way to put it. And what's truly fascinating here is the massive regulatory pivot this implies. I mean, up until recently, the SEC, under the previous administration, forced issuers to completely strip out any staking components.
Right, they had to take it out.
This is a clear signal that the climate has changed rapidly under the new SEC chair, Paul Atkins. His administration is clearly departing from that old restrictive stance. This isn't just a win for BlackRock. It's a huge systemic win for Ethereum.
It validates it not just as a store of value, but as a yield-bearing financial asset class.
Explicitly.
But let's introduce some friction here. If the institutional standard becomes staking, and products like ETHB capture that yield in these huge centralized trusts, doesn't that maybe conflict with the decentralized ethos of Ethereum?
That is the critical question. On one hand, it guarantees demand. It removes the fear factor for trillions of dollars sitting on the sidelines. But on the other, if it's approved, it will set a new baseline expectation for all crypto products.
But if the asset generates yield, the product has to capture it.
Yes. And that expectation then fuels even more institutional accumulation. The potential for vast amounts of ETH to be locked up permanently in these trusts. It presents a very real possibility of a long-term supply crunch.
Making the asset increasingly scarce for everyone else.
And the newsletter certainly supported that idea of relentless accumulation. We noted that BitMine added another 138,452 ETH that week alone. That pushed their total holdings well past $12 billion.
The appetite for yield and the asset itself is just insatiable, which drives us right into the next problem. How can these institutions actually use the blockchain reliably?
That shifts us directly to December 10th, the dedicated payment rail. Because if institutions are going to hold billions and want to move it, they need infrastructure that doesn't fail every time a dog token goes viral.
This is where Stripe and Paradigm stepped in with the launch of the Tempo Public Testnet. It's a blockchain specifically engineered for high-volume stablecoin payments.
And backed by a consortium of heavyweights. Mastercard, UBS, Kalshi, joining partners they already had like Visa and OpenAI.
The problem they're addressing is what Stripe famously called the developer experience gap. General-purpose blockchains, Ethereum or Solana, they're so volatile with gas fees during periods of heavy congestion.
Yeah.
If you're running payroll or handling B2B transfers, you just can't risk your transaction getting delayed for hours.
Or suddenly costing 10 times what you expected because of some DeFi frenzy. That guaranteed reliability is essential for any business-critical function. You can't tell your supplier the payment is delayed because transaction priority was auctioned off to a meme coin bidder.
So how does Tempo solve this?
It has two crucial mechanisms. First, a fixed fee model. We are talking fractions of a penny, around 0.1 cents per transaction.
Wow.
Second, and this is the real game changer, it segregates payment traffic from trading volume.
So Tempo is basically creating an institutional express lane that's physically shielded from all the retail trading chaos.
Exactly. It guarantees predictable, reliable delivery for high-value transfers. It ensures a hype cycle on another chain can't spill over and clog this dedicated payment network. This is a monumental infrastructure play.
And it coincides perfectly with the political environment. As our newsletter mentioned, the Trump administration has been fostering a clearer regulatory framework, which gives massive players like Stripe the confidence to deploy this kind of foundational tech.
It's a technical solution meeting a favorable regulatory moment, and we saw related activity that same day, Stripe rolling out USD-settled stablecoin payments across Ethereum, Base, and Polygon. They are committing to this multi-chain future.
But Tempo shows they recognize that certain transaction types need their own, proprietary high-throughput solutions.
Which brings us to the end of the week, December 11th and 12th. And this is where the story gets deeply complex. It's blending partisan politics with this quiet, enormous adoption of blockchain by the legacy system.
The regulatory crossroads.
This is the highest leverage moment of the week. Let's start with the political fight on the 11th.
Okay, so Senator Cynthia Lummis was pushing hard to get the Responsible Financial Innovation Act to a markup hearing before the holidays. This bill is the major legislative push for regulatory clarity in the U.S.
And it aims to shift significant oversight away from the SEC toward the more commodity-focused CFTC.
But legislative clarity is never easy. We immediately saw fierce opposition. This wasn't just typical partisan debate. It was major FUD emerging from influential consumer groups.
Specifically, the American Federation of Teachers, the AFT.
What were their core concerns, particularly around pensions?
They urged the Senate to scrap the bill entirely, citing profound risks to worker retirement funds. The concern is that if the bill passed, it would legitimize digital assets prematurely. It would allow pension managers to allocate funds toward what the AFT sees as speculative, volatile assets.
Potentially risking teachers' retirement security.
Exactly. It's a profound conflict between market access and worker protection. And then you add the political layer on top of that.
Democrats were simultaneously raising ethics concerns about President Trump's high-profile crypto dealings. So the House might have passed its version, but this Senate drama created a messy logjam,
leaving the outcome uncertain and potentially delaying any real clarity until well into 2026. This is that messy political battle playing out in real time.
Which is why the news that dropped on December 12th is arguably more revolutionary than any piece of legislation. We're talking about the DTCC.
The Depository Trust and Clearing Corporation.
Often called the plumbing of Wall Street. For the listener who might not deal with post-trade infrastructure daily, what exactly is the DTCC and why is its involvement so earth-shattering?
Think of the DTCC as the central processor for virtually all securities transactions in the U.S. When you buy a stock or a bond, the DTCC is the entity that guarantees the settlement and the custody. They process quadrillions of dollars annually.
Quadrillions.
They are the absolute bedrock of the entire traditional U.S. financial system.
And the news was that they received a pivotal no-action letter from the SEC. That sounds technical, but what does a no-action letter actually achieve?
It's critical regulatory assurance. It means the SEC staff reviewed the DTCC's proposed plan, in this case, tokenizing real-world assets, and stated they will not recommend enforcement action. It's not full codified law, but it's a massive, formal regulatory green light.
A temporary stamp of federal approval to just proceed.
Exactly. And this allows the DTC to begin tokenizing crucial real-world assets, the Russell 1000 index, ETFs, even U.S. treasuries. And these tokenized assets will carry the same legal standing and investor protections as the traditional ones.
This is monumental. The 2026 rollout aims to integrate blockchain directly into the core engine of global finance.
By tokenizing these assets, the DTCC is creating a single pool of liquidity, offering collateral mobility and vastly improved efficiency across various L1s and L2s. This validates blockchain for trillions of dollars in traditional market value.
It confirms the largest institutions are adopting the rails, not just observing them anymore.
If we connect this back to the bigger picture, the institutions, Bitmain, BlackRock, Stripe, they were all building toward yield, infrastructure, accumulation.
And suddenly they have a massive, federally approved avenue for deploying and mobilizing that wealth on-chain.
It just demonstrates how swiftly that gap between crypto innovation and traditional finance is closing. The DTCC's decision is not an experiment, it's an operational commitment.
So what does this all mean for you, the listener? We moved from Beeple's high-stakes cultural statement and BlackRock's hunger for yield, right through the foundational payment infrastructure and into the most significant regulatory and tokenization news of the week.
It means the innovation engine of DeFi has been, well, officially ratified by the most powerful post-trade infrastructure entity in the world. And that leads to a final provocative thought for you to consider.
Go on.
The DTCC move not only validates RWA protocols that have been building organically for years, but it immediately places the federally approved clearinghouse in direct competition with them.
So this raises an important question. Will the DTCC's standardized, institution-grade tokenization model just eclipse the organic, faster-moving, crypto-native RWA platforms?
Or will the DTCC simply fuel a broader RWA supercycle, acting as a massive institutional feeder that makes the entire sector just explode?
Something powerful to mull over as you track where those trillions are heading next.
Thank you for joining this deep dive into our newsletter. We hope these concentrated insights help you stay ahead of the curve in this rapidly evolving market.
If you found these insights helpful, make sure to follow Nifty Noon on X and Substack for all the daily updates we synthesize into these deep dives. We'll catch you on the next one.